welcome back to this week's market update. Today is Friday, December 8th, 2023, and we had an important week with some really good jobs data, so we'll jump right in here. With key inflationary data and a Fed meeting next week, markets made a bit smaller moves this week awaiting Friday morning's key employment data, which placed the November unemployment rate at just 3.7%. As of close on Thursday, December 7th, the Barclays Aggregate Bond Index ended 0.6% higher for the week, while the Nasdaq ended up about 0.2% higher for the week, the S&P down about 0.2% for the week, and the Dow down about 0.4% on the week. Heading into this week's data, we got the ISM Services Index for the month of November, and it clocked in above estimates this week at a slightly bullish 52.7%, which also happened to be the 12-month average as of this month as well. This marked the 41st month of growth out of the last 42 months, despite this 1 month of negative territory there in December of 2022, but just represents a continued trend of bullishness in the services sector. Also in this month's survey, respondents reported strength overall in the fourth quarter so far, while expressing concerns about continual inflationary pressures, although to quite a lesser extent compared to a year ago. So overall, we're seeing services sector appear to be faring much better than most would have expected at this point in the year, and we will continue to watch it closely. Moving on through our week, we got consumer credit data for the month of October, showed a 1.2% increase from a year ago in total credit outstanding, and that was led heavily by revolving credit, which increased 2.7% from a year ago, and not so much from non-revolving credit, which only increased 0.7% from a year ago. Compare this to even just the third quarter here, especially in terms of revolving credit, which includes things like credit cards, lines of credit, those sorts of financial products. It is increasing at a much more moderate rate than it was even in Q3, Q2, and Q1 of this year, especially when you look at 2023, that double-digit increase in revolving credit. So a lot of this could be attributed to higher rates spooking consumers away from using their credit cards as much. However, it could also be the case at the same time that consumers are pulling back on their discretionary spending that typically ends up on a credit card. So we'll continue to watch this, see how the consumer's doing, and see how that might affect our portfolios. Probably the most closely watched data point of this week, the November jobs report, clocked the unemployment rate in below expectations at 3.7%, which was also down from last month's 3.9% unemployment rate. On the other hand, non-farm payroll came in at 199,000 jobs gained in November, which was 17% more than what economists were expecting. Average hourly earnings grew at a monthly rate of 0.4%, which was largely expected with the rebargaining of many unions in November, but it was faster than the 0.3% expected from economists. The labor market remains a lot more resilient than what most would have expected, especially if we look back at the Fed's first summary of economic projections this year that they released in March, and they thought that the unemployment rate was going to end the year at 4.5%. So a long ways from that, and it's pretty much impossible that December's unemployment rate would tick up that much in just 1 month. So really strong job market here, showed that again in November's jobs report, and we will continue to watch the data closely. Also on Friday, we got the Consumer Sentiment Index from the University of Michigan, clocking the index at 69.4, and that was an increase of 16.1% from a year ago. And we also saw the index of consumer expectations up 10.7% from a year ago. On the other hand, the current conditions index was actually up 24.2% from a year ago, which may largely be a product of a stronger stock market compared to the same time last year. Overwhelmingly, though, we are seeing consumers feel better about the economy compared to a year ago. Here you can see the dip in consumer sentiment that we saw in the second half of 2022, but it is nowhere near these pre-pandemic levels in terms of this index. So continue to watch this, see how consumers are doing, but really good stuff to see. Looking ahead to the Fed meeting on Wednesday, December 13th, markets are pricing in little chance of another rate hike with just a 1.8% probability of that 25 basis point rate hike to come, with a 98.2% chance that they will do nothing in terms of moving the rate. More importantly, though, from this meeting will be the quarterly summary of economic projections, where we will see kind of what the Fed projects over the next few years in where they think rates will be, where they think unemployment will be, GDP, etc. So that'll be pretty important to watch alongside the meeting. When we scale back a little bit, looking at where expectations have moved over the last few months of where rates will end in December of 2024, the probability of rates ending above 5% has quickly diminished in the last few months, especially as Powell and other Fed members have spoken kind of against the possibility that they might hold rates this high into the end of next year. And that probability has moved from well over 30% in late October to basically no probability at a 0.33% probability this week that rates will end 2024 above 5%. So this will be really important to see how their summary of economic projections changes these expectations. It's been a while since we've had that summary of economic projections, and a lot of cooler inflationary data and stronger employment data has come in since then. So we'll continue to watch on the Fed as we approach this next Fed meeting and see all the other data points as they roll out. So thank you for watching our market update this week, and we look forward to providing another update next week, especially with the upcoming Fed meeting. So thank you, and we will see you next week.